Welcome back to Portfolio, everyone. And in today's video, we are doing a Saturday stock battle between ticker symbol DUK, Duke Energy, and Southern Company. These are two utility companies with market caps over $50 billion. These are very large companies who operate within the same sector of the market. And today we're doing a battle between these two stocks to determine which one may be a better buy right now. And of course, we'll take a look at company fundamentals to determine at this current point in time, which company may be the attractive one over the other. So we're going to do a quick analysis over 10 key financial metrics, do a comparison between these two companies to evaluate which one we like more at the current financial position, and just do a quick overall brief analysis between the two companies and see if we like either to add to our portfolio today. So every single Saturday on this channel, we do a different stock battle between two direct competitors on the market. So today we have Duke Energy and Southern Company. Both utility companies, both nice high yielding stocks. So if you're looking for some consistent dividend income for your portfolio, you can take a look at one of these two options and we'll see by the end of this video which one we like better than the other. So thank you for watching, everyone. As you know, I'm the Gen Z investor, and every single day on this channel we talk about different stocks you can buy, overall stock market performance, and any other big stock market news and headlines. So please like and subscribe, and let's get right into this battle between Duke Energy and Southern Company. First, we're going to take a quick look at the share price charts for each company. Over the past 12 months, Duke Energy is down around 7.5%, so currently being traded around $82 a share, down 7.5% on the 12-month chart. You can see here they got hit hard by the March lows, have slightly recovered and been flat, trading around the $90 range for the past couple of months. So they have not fully recovered back to that pre-pandemic level where their shares were being traded over $100. If we take a look at their competitor, Southern Company, they are down 6% on the 12-month chart, being traded around $53.50 per share. You can see a pre-pandemic level and pre-pandemic high at around $70 a share. Once again, saw March lows, slight recovery, but are nowhere near back to that pre-pandemic level. So overall, both of these companies have very similar price charts. Of course, they're both utilities, both high dividend yielding stocks, and they actually both have very similar price, somewhat recoveries, but neither of these companies are being traded back at that pre-pandemic level. So let's jump right into the battle. The first battle on our list today between Duke and Southern Company is market cap. So Duke's current market cap is around $60 billion, and Southern Company is being traded at $56.6 billion. So with this battle, the larger market cap company wins, so Duke gets the first one in today's video. Of course, market cap is not the most important financial metric, but I did want to include it just to show you the size in comparison for these two companies. Very similar with regard to how they're being traded on the market, very similar market caps, so these financial metrics are going to be very nice to compare because we're evaluating companies of very similar size. If we continue on down, the first key battle with regard to how companies generate some income is revenue. So Duke brought in $24 billion of revenue in the past 12 months, and Southern Company has brought in $20.55 billion. So Duke wins this battle because they are bringing in more revenue, and of course it does determine on companies, how much revenue they bring in compared to their market cap. But overall, these companies are very similar with regard to market cap that I just did a direct comparison with revenue, and Duke wins this battle. Continuing on with another income statement number, it is net income and profit. So of course, it's great to see companies bring in revenue, but that's the top line of the income statement. We want to see what that bottom line number is and how much income and profit is left over after all expenses for each company. So Duke, with their $24 billion of revenue, brought in $2.15 billion of profit in the past 12 months, compared to Southern Company, who, even though they generated a little bit less revenue, actually was more profitable and brought in more profit than Duke in the same 12 months. So Southern Company brought in $3.23 billion in profit in the past 12 months and actually wins this battle. So of course, now we take a look at profit margin. So Southern Company brought in less revenue, but actually earned more profit. So they have a higher profit margin of 15.72% compared to Duke Energy's just shy of 9% profit margin. So Southern Company wins this battle, and they are tied 2-2 with regard to income statement. So both of these companies are long-standing utility companies. These are companies that have been operational for a long period of time, and they continue to generate consistent cash flows each and every quarter into their business. That's just how the utility sector kind of works. People need the consistent utilities and they pay that same monthly bill month over month, year over year. So these companies have very predictable long-term cash flows coming into the business. So with regard to income statement, so far these companies are tied 2-2. Moving on, the next financial metric we have to take a look at is how fast these companies are growing revenue. It's great to see that Duke posted higher revenue in the past 12 months, but how are these companies doing with future growth? Of course, these are slower growing companies. These are cash cow, high dividend yielders. So we're not expecting double-digit revenue growth. And what you can see here is over the past 3 years, Duke has been averaging 3.32% annual revenue growth compared to Southern Company, who has been growing revenue at an average of 3.07%. So Duke wins this once again. So they have been growing revenue slightly faster than Southern Company, but this was very close. Both companies growing revenue annually over the past 3 years by just over 3%. Continuing on, the next battle is PE ratio. So this is a forward PE for both company, and what this shows is how much investors are willing to pay per dollar of company earnings. So the lower the PE ratio within this battle is the one that wins, because it just kind of says investors are buying into the company for a cheaper price. They're spending less money per dollar of company earnings. But of course, these companies are operating with the same sector, so it's fair to do a direct comparison. And you can see here, Duke Energy has a forward PE of 16.65 compared to Southern Company's 17.01. So once again, Duke wins this battle, but these are extremely close metrics. You can see for revenue growth, very close comparison, and same with current forward PE, very close battle between these two companies. Very similar in how these companies operate and how they're being traded on the market. Next, we have to take a look at is dividend yield. So of course, with utilities, we like those high yielding stocks. We use utilities to provide consistent dividend income into our portfolios, and usually utilities are yielding a little bit higher of over 3+%. So we take a look at these two companies. Duke's current yield is 4.7% compared to Southern Company's 4.78%. So higher yield here is the winner, so that goes to Southern Company with a slightly higher yield, but once again, these yields are almost identical. 4.7% for Duke compared to 4.78% for Southern Company. So these two companies are yielding almost the same rate right now. So if you were to purchase both companies with the same amount of money, your starting yield would almost be identical. So overall though, Southern Company does get the slight edge in this battle and gets the point here. With regard to dividend, of course we like to collect that nice starting yield at around 4.7%. But we also like to see consistent dividend growth. We want that dividend income growing each and every year. So for each company, we have to compare their 5-year dividend growth rate. Duke Energy has a 3.52% 5-year dividend growth rate compared to Southern Company at 3.39%. So Duke wins this battle. They've been growing their dividend at a faster rate over the past 5 years annually compared to Southern Company, but once again, it is extremely close. The last 4 comparisons for these companies, they almost tied. Their yields and their dividend growth rates are almost identical, and these companies are performing in a very similar manner. Moving on, of course, with dividend, it's great to see a nice high yield, at a very slow 5-year dividend growth rate of only 3.5% for both companies, which is to be expected in the utility sector. Next thing is, how safe is the dividend? So we use a dividend safety score from Simply Safe Dividends, and that just gives you an indication on how safe each dividend payment is, and if the company is financially stable enough to continue to pay out that dividend and actually grow each dividend each and every year. So both of these dividends are considered safe. Between 61 and 80 is considered safe on Simply Safe Dividends, and both of these companies fall within that range. So although Duke Energy is the higher and wins this battle with a dividend safety score of 80 compared to Southern Company 65, with regard to categorization, they are both considered safe, even though Duke Energy is considered a bit more safe than Southern Company in their dividend payment. Earnings per share payout ratio is the next thing we have to take a look at, is because with utility companies, of course, they are yielding a lot of money. They do have that consistent, predictable cash flow, so they know what they can afford to pay out as a dividend. And these are companies that usually have somewhat higher payout ratios, but you always want to make sure that their payout ratio is sustainable. So what percent of their earnings are actually being paid out as a form of a dividend? You can see here, ticker symbol DUK is paying out 78.2% compared to Southern Company's 81%. So Duke wins this battle once again with a slightly lower dividend payout ratio. Personally, for my dividend paying companies, I like to maintain companies who have a payout ratio below 75%. So both of these companies are above that 75% threshold, but not by much. And of course, within the utility sector, higher payout ratios is more common. Nothing too worrying at the current moment for both of these companies, but it would be nice to see them bring down that payout ratio into the future. So again, another battle that was extremely close, 78% compared to 81%. These companies are very similar with regard to their current financials. Next we have to take a look at is the balance sheet. So we took a look at the income statement, we took a look at their dividend, how safe that dividend is. Next we have to take a look at is their balance sheet to determine how the company's financial position is as of their last report. So the current ratio is the amount of total current assets compared to a company's total current liabilities. So we want this number to be high because that just shows a company's got a lot more total current assets compared to their current liabilities, and they can handle all of their debt within the next 12 months with all of their short-term assets on hand, and they are not really too worried about that short-term debt. So what we'd like to see with this current ratio is we like to see companies with a current ratio of at least 1. So the higher current ratio wins this battle, and that actually goes to Southern Company with a current ratio of 0.97. So their current ratio is close to 1. Of course, the higher the current ratio, the better. So it's great to see companies with a current ratio of 1.5 or 2. But with regard to utilities, once again, another sector of the market which has lower current ratios, they have the 0.97 current ratio. So they win this battle. Duke Energy's 0.55% current ratio, in my opinion, is very low, and they should really try to bump that up, increase some of their current assets on hand or cash or short-term investments, just to have more assets in the next 12 months to be able to pay off those liabilities without worry. Moving on, the final metric we have to compare is another balance sheet metric, is the debt to equity ratio. So it just shows a company's comparison from their debt to equity, and the lower this number, the more safe or less risky a company is because they have less debt compared to their overall equity value in the company. So both of these companies carry high debt to equity ratios of 1.42 for Duke Energy and 1.54 for Southern Company. Like I mentioned, the lower of the debt to equity ratios win because, of course, it just shows that this company is a less risky investment. There's more equity on the balance sheet compared to a company's debt. But overall, both of these companies operate within a sector of the market which involves high, I'm going to say, mortgage and investment in their capital expenditures in order to operate the business. Utilities need large facilities in order to generate and distribute their power. So, of course, they carry a lot more debt in order to pay for those facilities. But of course, their business cash flows are always also very consistent, so they can afford to carry this high amount of debt on the balance sheet. So this was our stock battle between Duke Energy and Southern Company. So Duke clearly wins this battle, taking it with a 1, 2, 3, 4, 5, 6, 7, 8 to 4 victory over Southern Company. Both companies, though, you have to say, are very similar with regard to their current financials. Although Duke does slightly beat Southern Company in a couple key metrics, both these companies are extremely similar. And if you have funds that you want to put into the utility sector, and these are the two you are looking at, it might even be worth splitting it between the two just to get a little bit more diversity, and you're really getting the same type of company. So Southern Company is a little bit more profitable with a higher profit margin. They are actually yielding slightly more than Duke right now, and they have a better current ratio. But Duke is the larger company that is actually bringing in more revenue each and every year. They're growing their revenue faster than Southern Company, and they are raising their dividend. They have a safer dividend over the past couple of years. But once again, these companies are extremely similar. Their financials are almost identical. If you're looking for a utility stock to add to your portfolio, either one can be a solid option. Do your own research, of course. You can do a much deeper analysis and comparison of these two companies. This was just a brief overview to get a nice understanding of each company's key financial metrics and how they compare to one another. But there's so much more you got to do to look into these companies to get a perfect financial decision. So thank you for watching, everyone. I'm the Gen Z Investor. We post videos every single day on this channel, and I will see you in tomorrow's video.